Interest rates literally crashed in the pandemic. The Federal Reserve came out of nowhere and took interest rates down to as low as they could possibly go to be able to attempt to protect our economy in one of the most uncertain times that we've ever seen. They did an amazing job, but there's much to understand about interest rates. There's much to understand about risk and reward and what some people perceive to be a safe part of their portfolio. We need to understand that. We're going to discuss it today on Consider This Program. Well, good morning and welcome to Consider This Program. I'm your host, Joe Clark.
And I'm Adam Harter.
Happy to have you along, Adam. For those of you who don't know, Adam is our Chief Investment Officer. He's a Chartered Financial Analyst, CFA. So imagine if you have one of those bloody mutual funds and you open up the door and you actually have the ability to meet the manager. That's what we offer at the Financial Enhancement Group. And by the way, the CFA would be credentials most likely behind the name of the manager. It's as high of a designation as you can get in the investment world from a management standpoint. Adam's been with Financial Enhancement Group for over 20 years, one of my partners and a dear friend. So we're going to talk about one of his favorite topics. I promise you, if there's anybody in the world that can make interest rates not boring, other than Lacey Hunt, one of my favorite economists, I would leave that to Adam Harter, because you're going to see true passion come out of his very soul, if you will. It's just going to come out. So Adam, here's the deal. The FOMC not only took interest rates to zero, but they've promised us for 2 years they're not going to do squat about it. They have what we would call a dovish group of people that are voting now. The probability, the likelihood of any change is slim to none. So, brother, why in the world would we be discussing interest rates at this point in time?
Oh, good question, and thank you for the comments. And can't help what you're passionate about. This is my wheelhouse, and I do love it. But you raise a good question. We know that the FOMC, as you put it, the Federal Reserve, they control short-term rates. They control what banks charge each other on an overnight basis, and that spills over and is really tied to other short-term rates. So if you have a 1 year or a 2 year note, they're going to control that as well. However, as you get a little bit longer term, think of mortgage, think even out longer term car borrowing, anything that's out beyond that, the market controls. The Fed doesn't actually directly have any control over that. That's the participants that are buying and selling debt that could control those interest rates. So even though the Fed wants to keep those short-term rates anchored and are doing nothing to it, we have seen interest rates, as you put it, crash through the crisis and have been rising dramatically ever since, and going through the roof here, seemingly when you're just looking back over 1 year at the start of 2021 here.
It is very difficult for people who are coupon collectors, right, to see much of a difference between a 1% 10-year Treasury and a 1.35% Treasury. What does that mean in the real world?
It doesn't sound like much, does it?
No.
It really doesn't, and I get that. And the answer to that question is going to be found on monthly statements that come that are for investors who are invested in a lot of bonds, because the amount that will do in terms of the price damage is going to be enough to get people's attention. In fact, in many measures, for those that are invested in the Barclays aggregate bond, which is the S&P 500 for the bond land, many investors most are tied to that. They're going to find out that was enough to produce one of the worst starts in history. 1 to 1.3 doesn't sound like a lot, but it's enough to do some damage when you're expecting preservation, when you're expecting that ballast for your portfolio.
It's an ugly thing. I've always, Goldman Sachs teaches their new people bonds like this, so I don't feel bad about making the airplane. But the bottom line, and I know on the radio you can't see this, but if you have if you have the interest rates on one side and the value of existing bonds on the other, when interest rates go up, the value of existing bonds go down, and vice versa. Interest rates go down, the value of bonds went up. And so when these things went crashing last year, what we saw was the bond portfolio up about 7.5% for 2020. It was phenomenal. And then after the Biden election, right? And that's not to say anything about the president. It's just, we're just in a changing of a period of time. Inflation rates, I mentioned the market carver before. You ought to really get signed up for that. You can do it at yourlifeafterwork.com. But we talked about the Arbor research saying, based on inflation, the 10-year Treasury ought to be all the way up to 1.84, right? And we're still only about 1.3, 1.35 is the time of this taping, right? It's a phenomenal sum of money. So, Adam, so here we are. I'm 54, but I'm going to pretend I'm 62. and I'm thinking about retiring, and I hear and read all of this stuff on the internet that says I need 60% of my money in equities and 40% of my money in fixed income, what do you tell them? What do we say?
I tell them that as a baseline theory has been beneficial for many investors. And I think we're going to talk about Japan here in a little bit too, and investors that were in Japan that didn't adhere to that at all really felt the pain for not making an adjustment. However, it is a baseline. It's a guide. It's a call to be diversified. It's a call to have some balance in the portfolio. But at this point in time, it is not a great time to be anchoring yourself directly to the classic 60 and 40, because that 40, and more than any other time in my life, and you put it as a passion for interest rates, I have not seen such a toxic setup for bonds in my career. We have the lowest prospects for return, coupled with, and this is the key point, coupled with more risk. Bonds are not stocks. They are controlled by math. All right. They're very boring instruments, and new information coming in, whether the economy is doing this or that. Ultimately, bonds move by math. And the math inside of that, the composition of those indices, we're set up to be very risky.
The way I try to explain it, when you look at a bond on your portfolio, your stock is the stock price that you get on your portfolio is based on what a willing buyer and a willing seller made an exchange for the week before. The best way to understand how your bonds are priced on a statement is an appraisal. Think about how your house is appraised. I haven't moved for a few years, don't intend to, but it doesn't mean that my banker doesn't want a valuation, doesn't mean that there's not an appraisal if I'm going to refinance the house, right? But it's based on a subjective view of what other things have sold for in a similar amount. That's what he means when he talks about the math side.
And it's actually a little bit more than that, because inside that index are borrowers. Those bonds are ultimately people who are borrowed. What did those borrowers do here during the crisis? They went out and extended the terms of they raised new bonds, longer ones, smart, just like you and I. We got a chance to refinance our house, put it back out to 30 years at a low rate. These corporations are smart. They did the same thing. They want that low rate for a long period of time. So now, instead of having a 5-year bond, it's a 10-year bond. And while that may not sound like much, it adds that volatility, that add the risk to that investor who is the 60-40. So that 40 just got riskier because of the corporations that they were lending to did the right things.
So I'm going to talk out of both sides of my mouth and understand that, and Adam and I are the two directly responsible for over $600 million at the time of this recording, right? At the end of the day, it's our signatures that have to go on things. Now, there's a team of 29 people that we're very, very proud of, that do phenomenal work, that if we didn't have, there is no way we could accomplish what it is we accomplish. But 23 years of running the Financial Enhancement Group, here's where we are. And this is our responsibility, and it is our passion. So I will tell you, in my 32-year career, they taught me academically that there is a correlation between the market and the economy. And long-term, that may be true. It just doesn't seem to have been true in the 32 years I've been in the industry. And what Adam is trying to lay out for you right now is from what may be true about bonds being quote unquote less risky over an 80-year period of time may be accurate, but it's certainly not what we view as accurate as where we are right now in the economic picture today. Now, that's one side. Now, Adam, I'm going to give you the other. When I look at the key uniquenesses of the Financial Enhancement Group, one is that we teach people to be on a financial journey, not to get caught in a snapshot, right? And so what you're fond of telling me, and we lost one of our ladies to COVID this year that we've taken care of for years and years, who used to give you grief over bonds like crazy. Yeah. And me, because I always got copied on the message, right? And, bless Jan, and I'm sure she's with her hubby in heaven, and that life's good. But when we look at where we are right now, you will always tell everybody that we are on a journey, and you need to be smart about where we are today, but that doesn't mean abandon in entirety.
Oh, absolutely. Absolutely. And that's why that 40, going back to 60-40, is still a baseline. It's still your home. It's just the realization that 40, if you're just buying the market, is risky. So it's just, when that extra risk doesn't mean you abandoned it. You got to work a little bit harder and get a little bit more savvy around that edge. It was mostly because you're absolutely right. There's nothing more important in investing than staying the course.
Right.
And if you're set up in a way that, and again, what's this bad bond environment mean? It's down 1 or 2%. All right, that's a bad day for stocks. So in the end, you do have to remember that.
It is, however, an interesting thing. And when I started teaching at Purdue, the bond market was about 7 times larger than the stock market. Today, it's about 3 times larger, and very few people know that. And, I've been all over the world. I've been very, very blessed, and I've yet to see a bond channel. My joke is that only the Brits would watch it, because it is kind of boring to some. It ain't been boring probably the last year and a half. It has been anything but probably since the Brexit vote, frankly. Right, it hit the 10-year hit 161 and then fell back down, and then Trump got elected, and you watched the rise, and then it fell back down, and it has been a roller coaster. It's just most people don't know what that economic input means. So, the second part of our uniqueness, and there's really 3, but the second part is we teach people not to hoard their money. Adam and I and the Financial Enhancement Group, our team, work to help you understand how much money you can take out. We're going to talk about that in drawdowns here later in the show. But it's important for you when you're taking out income to be in these kind of boring fixed income bonds. So just real quick on that in terms of how you would say that, and then we'll end this segment.
Yeah, I think you put it exactly right. It is absolutely boring, and I can attest that, because a lot of these folks, you mentioned the CFA credentials, and I'll just tell you real quickly, I've had a couple of lunch and learns. Like we'll get together once a month. During the pandemic, like everything else, has been via Zoom. And I will tell you, this group of people is one where every single box is where the camera's turned off. Bunch of nerds getting together, and that's why you'll never see a bond channel. So the boring is healthy and good for the portfolio.
It is, but it's when you pension fund managers, like my buddy Lacey's in charge of $5 billion for insurance companies and few pension, and he really gets emotionally disturbed when he talks about the future of where fixed income rates are and the challenge that pensions are really in. And let's face it, folks, when pensions are in trouble, most of you that are trying to do this on your own are in trouble. Again, if you want to do this on your own, God bless, we'll give you everything we can to help you. But if you're looking for a fiduciary, that really is our business. And we would welcome you to call 800-928-4001. Go to yourlifeafterwork.com. Get signed up for your Next Steps meeting. It's complimentary. We look forward to meeting you. Again, it's 800-928-4001.